think, act, and prosper. You are now tuned into the Money Level Show.
Yeah, for sure. What's your take on bonds going forward? I mean, right now the yield curve is inverted, and then at some point it's going to steepen. But what's your take on 10-year notes and 30-year bonds and such? I've seen some articles of like bonds are in danger or something. I haven't read them, but I just wanted to see if you had any perspective on it.
Yeah, absolutely. I mean, bonds tend to move in very long cycles, like multi-decade cycles. So we had one cycle after the Civil War until the First World War, one long cycle. And in recent history, of course, we had a peak in rates in 1980, and rates essentially went down all the way until last year. When rates go down, bonds go up. So you had a very strong bond market for that's 40 years. And then before that, you had from 1950, so you had a 30-year bear market in bonds. So I don't think we should discount the fact that this turn is going to be a multi-decade turn. That's the first thing. The second thing is, I don't think rates are going back to zero. Now, they may have to cut rates at some point, but they're not going back to zero. And what I would say is that if you look at the rates that 10-year and particularly 20 and 30-year bonds are offering, they simply are not compensating you for the risk, even after the increase in rates we've seen. So if you get 3.5% on a 30-year bond, nobody that I know of is buying, no investor is buying those bonds with the intention of holding them as an investment. So you've got, government entities that are buying them. This is a huge sort of farce. But one arm of the U.S. government is buying these bonds that are issued by another arm of the government. But some hedge funds are buying them because they're looking for a dip in rates, so it's a trade. I think they're wrong. But certainly if the Fed were to pivot and take rates back to 2 or 2% or something like that, the 30-year bond will have a good pop. But they're buying it as a trade. They're not buying it as an investment. And for an ordinary investor, for you and me, it's much better to buy a one month, 6 month T-bill and earn over 5% than it is to buy a 30-year. The only reason, when you think about it as an investor, right, not as a trader or anything, but as an investor, there's only one reason to buy the 30-year bond today rather than to buy the 6-month bond, 6-month bill, and that's because you think rates are going to turn around and go dramatically lower. And you're locking in, if you can lock in if you think rates are going to 1% and you can lock in 3%, that's a good deal. But if rates don't go down to 2 or 1%, there's no particular benefit to buying the 30-year.
Mm-hmm. And there's also the other risk of like real rates, so like if you lock in 30 years at 3.5%, and then say interest rates do go down and inflation goes up, like you're at the risk of like having your purchasing power being eroded over that time period. Is that correct?
Oh, absolutely. No, absolutely. Long-term bonds someone described them once as a form of guaranteed confiscation. And Jim Grant likes to talk about return-free risk instead of risk-free return. But that's what you're getting. Now, short-term bonds short-term bills is a different issue. Even though 5% is barely above the rate of inflation, and if you have to pay tax on the interest, you're not making any money. But it's a pretty good parking place if you're nervous about the overall market. To get 5% on a 1, 2, or 3 month T-bill is a pretty good place to leave your money.
Hello everyone, sorry for the break in action, but I want to tell you about the link in my description below. This is to the New Orleans Investment Conference. This conference has been around for years and have brought many people out, such as Milton Friedman, Gerald Ford, Alan Greenspan, and Margaret Thatcher. This conference is put on by Brian Lundeen and his team. Brian is the CEO of Gold Newsletter. This year, they're going to have speakers such as Jim Rickards, George Gammon, Peter Schiff, Rick Rule, Danielle DiMartino Booth, Lynn Alden, and many others. Now, I encourage you to click the link in the description below. You can choose to attend the live event, which I will likely be at, as well as the event that is live streamed. You can support the channel by using my link below, so I encourage you to check that out. Now, let's get back to the interview. Yeah, agreed. So I want to transition to gold. So we've seen like the gold equities are still significantly down. I share with my audience, I started buying Newmont and the equities are significantly down compared to the gold price. Gold price of the physical metal is close to its all-time high, closer to its all-time high than the equities are. And many of these equities, can pay a solid dividend as well, versus like holding the actual metal, which is insurance, and it doesn't pay you a dividend. So what's your take on the gold equities right now?
Yeah, no, you've hit the nail on the head. I think the problem with the equities right now is that there is simply a total lack of interest. I mean, you and I and most of your listeners are interested, but the broader investing public, whether they're institutions or retail, the broader investment public is simply not interested in gold equities right now. And part of that is because, gold has failed to keep new highs. And part of it is because the broad market, at least parts of the broad market, are still doing well. So people just don't see the need to be investing in gold, let alone in gold equities. I mean, the gold price has really been held up by central bank buying. It's not been held up by retail buying. You look at the ETF flows, and this year, for the last 9 months, they've been pretty much negative every single week, apart from, January, February. So, you don't even have strong flows into gold itself, but the gold stocks are even worse. Now, I will say that the gold stocks generally, the gold mining companies generally, are in a far stronger position today than they were, say, 10 years ago. The balance sheets are stronger. The XAU is cash flow positive cash positive. If you look at the balance sheets in aggregate of all of the XAU companies, that's quite astonishing when you think that mining is a capital intensive business. The dividends for the XAU are higher than they are for the S&P. Again, it's very unusual. You look at, we're talking about inflation. Everyone's talking about costs going up. But if you look at the price of gold at $1,900 and the all-in sustaining cost of a gold company is $1,250, and the cash cost at a mine is maybe $750, you've got a very robust margin. That's one of the most robust margins that they've had for the last 20 years. So the mining companies are in good shape. The outlook is good, and the stocks are just ridiculously cheap. And we talked about this last time, and frankly, Daryl, they've just got cheaper. You look at price to cash flow, which is or price to free cash flow after dividends, interest, and debt, is one of my favorite metrics. And the XAU stocks are trading pretty much in the lowest 25 percentile but they have for the last 50 years. So in other words, on that metric, they're as cheap as they've been for 50 years. And if you look at other metrics, price to book value, price of gold in the ground, price of reserves, blah, blah, blah. We're definitely trading today at lower than that long-term average. Given where the price of gold is, we should be trading at above average valuations. So I think the gold stocks are just stupidly cheap right now, the good ones.
Yeah, definitely. Yeah, it's a I saw the price of them start to dip. Now I'm looking in more of the royalty and streaming companies as well, just to have some diversification in the gold stocks. So what's your take on the dollar? So right now the dollar, last year we had a strong dollar. Do you see a strong dollar coming back again at some point?
No, I'm not in the camp that thinks the dollar's going to sort of collapse anytime soon, because it has to collapse against something else, right? And the euro, the yen, the British pound, they're all in bad shape. But I think we've seen the highs for the dollar. So it might be a slow decline, but I think it's downhill from here. But I don't see anything. I don't see a dramatic sell-off in the near term. And Rick Rule, we were at his conference. Rick Rule likes to say that just because it's inevitable doesn't make it imminent, which is something we need to bear in mind. Things always take longer to play out than we think they should. We're seeing that with the interest rate hikes in the economy. Everybody said, oh, if they raise rates. Back a year ago, nobody thought the Fed would go to 5.5%. Nobody I know. Sorry, I've lost you. Where have you gone? There you are. Nobody thought they'd go to 5.5%. But even going to half of that, people thought it would crush the economy. Maybe that's inevitable, but it always takes longer to play out than people think. So with the dollar, yes, I think it's inevitable, but it's going to be meaningfully lower at some point. But it's inevitable. But another currency will take its place as the world's reserve currency, another currency or basket of currencies. But these things take much longer to play out than we imagine.
Agree. Many people were very hyped about the BRICS meeting, and they thought that they were going to announce like being gold backed or linked or something like that, and they came out and said, the South African president came out and said that they're looking at the financial aspect of it and they have their experts on it, but they're not even going to report it until like the next year.
Yeah, and it's going to be much longer than a year. But we are chipping away at the margin, both in terms of assets and in terms of dollar use in trade. So if you look at gold as a central bank, the dollar as a central bank asset, 20 years, almost 75% of all central bank assets around the world were in the dollar. Now it's at barely 50%. That's a very significant decline, admittedly over a couple of decades, but a very significant decline in something that tends to be very, very slow moving, right? If you look at trade, most trade by far is still in the dollar. But again, we're chipping away at that. And everybody knows all the factors, but the Chinese and Saudis agreeing to trade oil in the yuan, that's very, very meaningful in the long term. It's not meaningful in absolute dollar terms in the immediate. I'll agree with, there's a lot of people who poo-hoo this whole idea. So I'll agree with them that it's not significant in practical terms in the immediate sense, but it's very significant, I believe, in the longer run.
Yeah. So, Adrian, as we wrap up, what are some things that the average investor or person could be doing now to prepare for recession or just all of these things that we talked about, these concerning topics? What could people be doing to kind of prepare and try to reduce that amount of pain that that others may experience when this all hits the fan?
Well, I think so. Number one, I would say don't wait too long. Don't think you can stay in the stock market until it's gone down or until it's rolling over. Don't wait too long. I think I think people should really try to build up as much savings as they can now before they're forced to. So I know a lot of people, people living paycheck to paycheck, month to month, don't have any, certainly don't have a lot of excess. But, the time will come if there's two working people in a family and one of them loses the job, the time will come when you are forced to retrench. So it's a lot better to retrench now and try to sort of put a little bit of savings away. That would be the first thing I would say. And then if people are invested, I would be getting out of most US stocks and most developed market stocks, pretty much as quickly as I could, with very, very few exceptions. And again, I wouldn't wait for the top. I would get out while I could, putting some money, if you have sufficient funds, putting some money into treasuries, short-term treasuries, and just parking it there and just waiting. No one I know, very few people I know have ever regretted having too much cash set aside. Now, of course, if in 1982 you said, this market's not going to go anywhere, and you put everything into cash, well, you probably feel a little bit of an idiot right now. But very few people who sell assets and put money into cash as a parking place ever regret that. So I would put money into cash and I would accumulate the gold stocks, continue to accumulate the best quality gold stocks every time that there's a dip. Because we both know when gold turns, then the gold stocks can move dramatically. You only have to look back to 2008. We had a global financial crisis, they called it, and the XAU peaked at August and it fell all the way down to October. But from October to March, the XAU more than doubled, right? From October to March, it more than doubled. The gold stocks move very, very quickly when they move. And of course, it went up fivefold by 2011. But just in the 5 months there, it more than doubled. So I would buy those good quality gold stocks, at low prices while we can.
Yeah, agreed. Well, thanks, Adrian. Appreciate you for coming on. Where can people find more about you?
Well, the website is Adrian Day Asset Management, adriandayassetmanagement.com. And the email is assetmanagement@adrianday.com.
All right. I'll be sure to link that in the description below. Thank you for your time and your wisdom.
Well, thank you, Daryl. And yeah, I'd like to do it again. I'll try not to be so long-winded next time.
No, it's good. The more information, the better.
Okay. Thank you.